And I am back for another video. Once again, Wolf Street, Wolf Richter, record apartment building boom, all of a sudden has met reality. All I think of, again, over and over, what was it like in 2004, 5, 6, and then 7 and 8? Not even really 4, more like 2006, 7, and 8. You know, flip houses, buy 2 houses. You'll flip them, you'll make fortunes, and everyone's doing it. And then all of a sudden, you couldn't. And people were trapped in their houses. Remember that? And then the foreclosure mills came up all over the place to deal with it. So let's see what we got here with Wolf Richter's wolfstreet.com article. Even the Fed put commercial real estate on its financial stability worry list. No, the crane counters were not wrong. 2017, fix my foot here. In 2017, the ongoing apartment building boom in the U.S. will set a new record. 346,000 new rental apartments in buildings with 50-plus units are expected to hit the market. How superlative is this? Deliveries in 2017 will be 21% above the prior record, which was set in 2016. Again, massive building once again. And do you remember the condos that were being built and the apartments that were being built, and then the whole entire jobs got canceled? And you drive by and you're like looking at these ghost town of a building complex, whatever it is, and there's no workers, there's no equipment, it's just sitting there, it's kind of rotting. Remember those? I wonder if that's where we're heading next with this. You know, for the next few years, couple years, if that. 21% above the prior record set in 2016. Based on data going back to 1997 by Yardi Matrix via Rent Cafe, and even 2015 had set a record. Between 1997 and 2006, so pre-financial crisis, annual completions averaged 212,740 units. In 2017, this will be 63% higher. How in the hell do you think this is going to end this time? Oh my gosh. These numbers do not include condos, though many condos are purchased by investors and show up on the rental market. And they do not include apartments in buildings with fewer than 50 units. This chart shows just how phenomenal the building boom of large apartment developments has been over the past few years. Rental apartments delivered. And again, let's take a look at this chart, just so you can see for yourself. This is beyond anything. Remember 2006, 5 and 6? We had this big boom, dot bubble, .com bubble crash, and then we had 06, 7, 8, boom, up, crash. And then we go up, and away like Superman, and then 2017 hits, and oh my gosh, let's set the record. Let's set the bar high. I mean, let's set that bar high. And all these companies saying, man, you see how high rents are these days? People are making a killing. We need to go out with get in on some of the action. Build a ton of apartment complexes because we're going to charge the hell out of people. We'll charge the crap out of them. And then the buildings will be complete. Maybe they'll get a year or two out of the suckers who basically have to pay their rent because they have no choice unless they want to live on the streets. And again, they won't be able to pay for other things. So if all your money's going to housing, there's no money for other things. And what happens when housing is so high that even though you don't have money for other things, you still don't have money to pay for the housing, or rent in this case. Prices have to adjust by force. The largest metros are experiencing the largest additions to the rental stock. The chart below, which I'll show you in a minute, I don't even know if we need to see it, we'll see, shows the number of rental properties to be delivered in those metros in 2017. But caution in over-interpreting the chart. The population sizes of the metros differ enormously. The New York City metro includes northern New Jersey, central New Jersey, and White Plains, and is by far the largest metro in the U.S., so the nearly 27,000 apartments it is adding this year cannot be compared to the 5,400 apartments for San Francisco, which is actually near the bottom of the list. The city of San Francisco is small, about a tenth of the size of New York City itself. and is relatively small even when part of the Bay Area is included. Other metros on this list are vast, such as the Dallas-Fort Worth Metro, which includes the surrounding cities, such as Plano. Driving through the area on I-35 East gives you a feel for just how vast the metro is. However, I walk across San Francisco in less than 2 hours. Special note, Chicago is adding 7,800 apartments, even though the population has begun to shrink. So this isn't necessarily going to work out. The building boom of large apartment buildings is starting to have an impact on rents. In nearly all of the 12 most expensive rental markets, median asking rents have fallen from their peaks, and in several markets by the double digits, including Chicago down 19%, Honolulu, San Francisco, and New York City. And it has an impact on the prices of these buildings. Apartments are a big part of commercial real estate. They're highly leveraged. Government-sponsored enterprises such as Fannie Mae guarantee commercial mortgages on apartment buildings and package them in commercial mortgage-backed securities. So taxpayers are on the hook, and banks are on the hook too. Wow. So if this happens all over again, are the taxpayers going to have to bail out Fannie Mae and Freddie Mac again? You could bet your sweet bottom. That's a big 10-4. And if you didn't see from the first chart I showed you, the appetite is enormous now. Get these apartment buildings up and running. Again, if they start to fail, the mortgages go sour, because a lot of these places will mortgage the property, the apartment building, make the mortgage payment while simultaneously collecting rent, exceeding what is needed for the mortgage. Then again, there are some companies, investment firms are backing them, whatever, and they simply they don't have a mortgage. They just go out and buy it and then collect the rents. Having said that, they got shareholders and stuff. And shareholders don't want to hear that the $1,600 a month rent has now turned to $1,200 a month rent due to a problem with the economy. And you certainly don't want to see that when if these companies have mortgages. Again, many of them do. They get loans on the entire property and then just pay it back with the excess of rent, above and beyond normal price of rent or whatever. This is big business. It is really big business. And it is now doing something it hasn't done since the Great Recession. The Commercial Property Price Index by Green Street, which tracks the prices at which commercial real estate transactions are currently being negotiated and contracted, plateaued briefly in December through February and then started to decline. By June, it was below where it had been in June 2016, the first year-over-year decline since the Great Recession. And here's a nice, pretty chart. And if you look at this one, you see that little camel? I'm going to call it a single camel hump for now. See that little camel hump, the top right corner? What do you suppose that trend is is telling us? Well, go ahead and go back to 2008. And as you see, you actually have already got it marked at the actual peak, September 2007. What do you see there? What happened next? Again, almost need to be a rocket scientist to figure this stuff out. No, actually, you just look at history and see what we dumb humans do over and over, and we never learn. Oh, no, gotta get in, man. The rents are great now. Let's build a bunch of car. Hey, excuse me. I'm like the lone shareholder, right, of the whole company. Excuse me. Oh, here comes Jay Snip. He's going to crush this for us. Go ahead, Jay Snip. What's on your mind, buddy? Listen, I don't want to be the guy that always poops in the punch bowl. But listen, it was only 2008 when we saw the same stuff for the same reasons, and we saw how it ended. Would you mind telling us why this time will be different? And I bet they wouldn't have an answer. They may say, well, the Federal Reserve's propping everything up, so that's why. We got the Fed backing us now. And I'm going to say, you might think you do. And to an extent, right now you do. But nothing lasts forever. And the Fed knows it can't continue doing that. Some segments of the CPPI were up, notably industrial, which rose 9% year over year, benefiting from the shift to e-commerce, which entails a massive need for warehouses by Amazon. and other companies delivering goods to consumers. But prices of mall properties fell 5%, prices of strip retail fell 4%, and prices of apartment buildings fell 3% year over year. So for renters, there is some relief on the horizon, or already at hand, depending on the market. There's nothing like an apartment glut to bring down rents. See what the oil glut in the U.S. has done to the price of oil? Investors in apartment buildings, lenders, and taxpayers, again, via Fannie Mae, etc., that guarantee commercial mortgage-backed securities, however, face a treacherous road. Commercial real estate goes in cycles, as that chart I just showed you shows. Those cycles are not benign. Plateaus don't long forever. And as a matter of fact, they don't even last long. And declines can be just as sharp or sharper than the surges. And these surges were breathtaking. Even the Fed has put commercial real estate on its financial stability worry list, as I just discussed in the last video, and has been tightening monetary policy in part to tamp down on the multi-year price surge. The Fed is worried about the banks, particularly the smaller banks that are heavily exposed to CRE loans, commercial real estate, and dropping collateral values. But the new supply of apartment units hitting the market in 2018 and 2019 will be even larger. In Seattle, for example, there are 67,000 plus new apartment units in the pipeline. Read crane counting in Seattle. Something has to give. He links to it, his own article. Again, is there some giant population boom, like the baby boomers part 2 taking place, that I just seem to not, being realist news and all, seem to somehow miss that one? Didn't do my, what I do every day and just somehow completely miss that one. Is that even possible? No, I don't think so. I don't think so, because that's, again, the same thing we always do. It's going to end the same damn way. This time will be no freaking different. Take care.